Gold is quickly replacing US Treasuries as their preferred asset that central banks hold in reserve on their balance sheets. And that's what we're going to talk about this week, because several commentators and market participants were sending a chart around this week showing how quickly central banks are starting to buy gold and how they are no longer buying treasuries. And of course, I got tagged on this with many comments that this is proof that the milkshake is wrong, has always been wrong, and that gold is the preferred asset on central bank balance sheets. So what we're going to do today is we're going to address it, and we're going to figure out, does this mean the milkshake has spilled? Does this mean that everything I have tried to explain to people is wrong? And is the whole game over? So let's just get into it right here. Put up the wrong one. Hold on. There we go. So this is the chart that has been going around. And it's a good chart, and it shows a share as a percent or share of reserves on central bank balance sheets that over the last, let's just call it 10 years, gold has been increasing rather quickly, and US Treasuries have been falling rather quickly. And of course, as I mentioned a little bit ago, this is seen as proof that the milkshake has spilled. I always think it's a very original comment when people make that. But, this is important. I assume if you're watching this channel, you're interested in what I have to say in at least some format. Maybe you watch it just to tell me how wrong I am. Maybe you watch it because you like what I have to say, or maybe you watch it because you're just trying to learn and understand how this all works and relates to each other. So that's why we're going to talk about it, because it is very important. And I think if you listen to what has actually been said, as opposed to what other people tell you that perhaps has been said, it may clear some up with regard to dollars, gold, and central bank reserves. But first of all, let's just talk, just to be clear, what is the milkshake? Well, the milkshake was a prediction back in 2018, because I thought we were going to enter a sovereign debt crisis. And as a result, I thought 5 specific things would happen. I thought rates would rise. I thought treasuries and bonds would fall. I thought the dollar would rise. I thought US equities would go up, and I thought gold would go up. Now, since I first mentioned the word milkshake, all 5 of those things have happened. And at certain times they were going in the right direction. At certain times they weren't. But overall, over that 6-7 year period, that's exactly what has happened. But let's take a little bit closer look on what we didn't get. I should say, what we didn't get, we did not get the sovereign debt crisis. We came pretty close in 2020 when the dollar spiked in COVID, and we came very, very close in 2022. But ultimately, we did not get the crisis. So as far as predicting the crisis, that was completely wrong. I hold up my hand. I say I did not get the crisis right. But everything that the milkshake predicted has come to be. And so let's walk through what that is, and what the overall framework is it's a framework that describes the process via which fiat dies and the whole system is reset. Now, I know some people are going to say, well, that's not what this is. It's just only about the dollar going up. But it is not just about only the dollar going up. The dollar going up is the catalyst. Markets in which we invest is what ends up being impacted by the dollar going up, and what that causes to happen. So let's just walk through, and I can show you exactly what I mean by this. My point has always been that the milkshake is ultimately about de-dollarization. It is about the process via which the whole system comes down. But the whole system comes down as a result of the dollar going higher, not as the result of the dollar going lower. And that is because to supply the dollars that increases the liquidity that causes the price to fall is done by lending new dollars into existence. When you lend new dollars into existence, that creates future demand for dollars. That is re-dollarization, not de-dollarization. When the dollar goes higher and causes defaults and causes dollars to disappear as you get a credit crunch, that forces then other countries and other entities to figure out new ways to act. That is de-dollarization, and that ultimately leads to the reset. But if we have the dollar falling and we have new dollar loans being loaned into existence, that pushes the problem down the road. it re-dollarizes the whole system, and it entrenches the US dollar as the global reserve currency. Now, notice, I've always said global reserve currency. I have never, ever once said the dollar will remain the global reserve asset. In fact, it's quite the opposite. And to prove that this is what I've said in the very first interview that I gave on this topic, I said the dollar milkshake theory is not one in which the dollar remains the world reserve currency. This is the whole system coming down. And now, I thought it would happen in 4 or 5 years. It didn't. Maybe it'll take another 4 or 5 years. Maybe it'll take another 10 or 15. I don't know. But I know the process, or at least I understand how the system is designed and what is likely to happen as we go through that process. So for anybody who says, I don't think that the dollar will ever lose global reserve currency status, the whole thesis is about the dollar reserve losing global reserve currency status. It's just not going to be as easy, and it's probably not going to happen in the direction that many think. Now, the other thing that I said about the milkshake was that it would have a huge impact on bonds. And in fact, I thought rates would rise after a 40-year bull market in bonds, and it's the rates rising that would cause treasuries to go down, and it would cause the dollar to go up, because as interest rates go up, it makes the dollar more attractive because you need dollars anyway. And, you get paid more to hold dollars, and then et cetera, et cetera, et cetera. I'm not going to go through the whole thing again, but rates rising and US Treasuries falling was a huge part of it. The whole thesis was about a sovereign debt crisis. A sovereign debt crisis is a process via which sovereign bonds get sold. In other words, treasuries get sold, but other foreign bonds get sold as well. And as investors want to leave bonds, as they no longer trust sovereign bonds, they have to find new places to put that capital. And the place we said that they would put that capital would be US equities and gold, and potentially some other places as well. Again, this is all in the original interview. I'll put a link to the interview in this in the description of this video here. And this is where I said bonds would fall. Now, initially, I was wrong. During the early stages of COVID, treasuries rallied, but then after that, they've been coming down ever since. So that is largely what has happened. Now, I will say, I have often said the US Treasury will be the last one to actually go default. In other words, other sovereign bonds will default long before the United States does. That is not the same thing as saying that treasuries are going to rally and interest rates are going to fall. In a sovereign debt crisis, all bonds can fall, all rates can rise. My point has always been, if the United States cannot get financing, then China cannot get financing, France cannot get financing, Turkey cannot get financing, Australia, et cetera, et cetera, et cetera. It's a relative game. Now, the other thing is I tried to explain as well as possible that I was going to walk in explaining the thesis. I was going to walk through it in a linear fashion, in a way of telling a story in order for it to make the most sense. But I clarified in the interview that it's not necessarily going to happen in a linear fashion like this. One thing might happen before the other. I may get the order mixed up a little bit, but essentially I expect all of this stuff to be going on kind of at the same time. And listen, I get things wrong all the time. I'm not smart enough to know exactly how all of this is going to play out. But the point is that all of this stuff was going to kind of happen together. And whether one happened first or second, I didn't really care. This is the things that I expected to happen in the future as rates rose and sovereign bonds started to get rejected. The other thing that I made clear is that my thesis on gold had not changed at all. In fact, the dollar going higher, I thought there was nothing more bullish in the long term for gold than the dollar going higher, because the dollar going higher wrecks the system. And as the system gets wrecked, even though governments might not want to remonetize gold, gold will raise its hand as the price rises and saying, see, I'm right here. You can use me if you're ready or if you want to. And so I've always said that gold would do very well. And, people ask me, I've always said gold is going to go to at least $5,000. It's probably going to go higher than that, but it's going to go to at least 5,000. I have never changed that once. And I've said everybody should always own gold. gold is one of the bedrocks of every portfolio. So this idea that gold doing well now and replacing treasuries is somehow anti-milkshake is just completely wrong. Treasuries getting sold and gold getting bought is literally part of the milkshake, and it always has been. And again, you can go back and look at the original interview and decide for yourself. The other thing is I said that I thought when gold really started to make its move, it would be driven by foreign buying, not U.S. buying. And the reason is because when a country's currency starts to lose value and go into crisis, that is when those investors really start to buy gold. And in 2022, when the dollar was really high and everybody else's currency was really low, that's when the rest of the world really started to buy gold. And then as the dollar started to weaken, it got since 2022, it really got a tailwind, right? But since we first started talking about it, the dollar is higher than it was, gold is higher than it was, US equities are higher than they were. And so this is all kind of playing out. But the point is it's been driven by China buying, by Europe buying, by Asian countries buying. It has not been driven higher by U.S. investors. It's not to say the U.S. investors aren't participating, and it's not to say they're not buying, but that has not been the primary buyer. The primary buyer, the slide that we started off with, it's foreign central banks buying and foreigners buying. And a lot of the reason that China's buying is people that don't wake up in China and say, Jay Powell is out of control, I'm going to go buy some gold. They buy gold because they don't trust the yuan. That is why they buy gold. But anyway, the foreign buying of gold has certainly played out. And the other thing, probably the most controversial part of the whole first interview that I gave was I said, dollars and gold will rise together. And some people have said, of course, that cannot happen. Dollars and gold trade opposite each other. You cannot say the dollar's getting strong if gold is rising because that proves that the dollar's weak. Well, I literally explained this in the very first interview, that what I was talking about the dollar rising, I was talking about its foreign currency peers, fiat currency peers. And in the same way that the dollar and the yen could rise versus the dollar and gold could rise versus other currencies. And so this is really, really important. And when people tell me if all fiat's getting debased, it doesn't matter and you should just buy gold. Well, if you're just a gold investor, sure. But if you operate a business, if you operate on the global stage in some kind of an economic manner, the dollar rising versus foreign currencies has a huge implication for markets. Now, if you're not involved in the stock market, if you're not involved in the bond market, if you're not involved in commodity markets, and if you don't run a business and you live on a mountaintop in Montana and you're self-sufficient, then maybe fiat versus fiat doesn't matter. But if you operate in the real world, it does matter. And that's why I think it's important to really, really understand this. The dollar rising versus foreign currencies is extremely important. And the dollar falling versus foreign currencies is extremely important because what that does is it kicks the can down the road. Now, look at what gold has done since the first time I started talking about this entire thesis. Gold has basically doubled over that time period, more than doubled, and it's done fantastic. And as the whole system is starting to come under question, gold is raising its hand and saying, "Here we are." Now it's not to $5,000 yet, and it's probably due for a pullback, but it will eventually go to $5,000. But as crazy as this chart looks here, it looks even better against foreign currencies than it does against the dollar because foreign currencies have fallen even more versus gold than the dollar. So the dollar and gold have risen versus fiat peers. And while we're talking about gold here, I want to mention again, you guys have heard me talk about this a little bit. I recently joined the board of Monetary Metals. I opened an account with them. Gold is next to real estate. Gold is my biggest single holding. I opened an account with them. And the reason I opened an account with them, the reason I joined the board is I really believe in this company. And the reason I opened the account is having an account with Monetary Metals is traditionally there's been a couple ways to own gold. One, you own bullion or you own coins. And that's basically, you're risk-free. You're very safe. You're on the left. There's no counterparty risk. It can't get inflated away. It can't get, all that stuff. And then on the other end, you own gold miners, which are very volatile. And for years they didn't do anything, and this year they're having an incredible year. But they're in equity, and they're much more volatile than your bullion that sits on the left side. Monetary metals is a way to own gold and have it in between there. And people tell me all the time that gold is money. Well, this is a company that's actually using gold as money. And so I always tell people, if you believe gold is money and you want to try to reintroduce gold to the monetary system, having an account at Monetary Metals is the perfect way to do it. Now, is it as safe as just putting bullion in a vault somewhere? Probably not. And so you should definitely keep some gold in a vault somewhere. Is it as risky as owning some gold mining shares? No, probably not. It doesn't mean you shouldn't own gold mining shares. It just means there's another part of the capital stack that you can own some gold and you can earn a yield on it. So anyway, I encourage everybody to go to Monetary Metals. If you go to monetary-metals.com/Santiago, type in your name, you can get all kinds of information on them. And anyway, I recommend you do it. Now, we'll go back to this, though, and I apologize. I don't know why that title got kind of reformatted like that. But, this is important. This is the process via which a sovereign debt crisis will eventually emerge. Now, I thought it would have happened by now, and it hasn't. But this is an example of how it can happen. And this is an example of how dollars and gold can rise together versus other fiat. It's an example of how interest rates can rise. Bonds fall, gold goes up, da 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 da. So what I thought I would do here is, what I'm going to do is I'm going to pull up a report that we wrote, as part of our research service. We wrote this back in February for our premium subscribers. I would encourage anybody that's watching this and hasn't had a chance yet, go check out our research site, research.santiagocapital.com. There's a couple different levels there. But we write a lot of different stuff about what's going on in the world, capital markets, the kind of the intersection of capital markets, geopolitics, and the madness of crowds. And something that we've talked about doing, we're going to do a report on stable coins. I wanted to have it done this week. It's just been crazy with work, and I haven't gotten to it. It's going to be probably the first or second week of October. So, if you want to get that presentation and that report, you're going to need to be subscribed to one of our services. But we really think stable coins are they're not necessarily a game changer, but they can definitely turbocharge the game. And so that's coming. But what I want to do now is I want to bring up a report that we wrote. I got to remove this first. Hold on. A report that we wrote earlier this year about this exact issue. Now, we used to call our research Macro Alchemist. We recently rebranded that just to Santiago Capital Research to avoid any confusion. But this was a two-part report. I think each report was 25 or 30 pages. And it's about this whole process. It's literally about the slide that is going around this week, talking about how treasuries are losing global reserve status and that gold is rising, and the implications that has for markets. And so what I thought I would do is I'm just going to share a couple little pages here. Let me go through this really quickly, because there was just a couple excerpts I wanted to talk about, because the problem is if US Treasuries lose value and interest rates rise, is that a problem for the United States? Yeah, it's a problem for the United States. The problem is it's a problem for everybody. And I'm going to explain a little bit why that is. But that's what this report really goes into a lot of detail on, and why U.S. interest rates going up and why U.S. having budget deficits and issues is a problem for the whole world, not just for the United States. So here, the global consequences of rising U.S. interest rates. The issue is that all of global finance gets priced off of the U.S. Treasury. So if U.S. Treasury rates are going higher, then anybody looking for financing in the corporate world globally, their interest costs are going up as well. And it puts pressure on the rest. This is why the rest of the world in 2022, when the Fed was raising rates and the long end was going up with it, the reason that England went into crisis, Europe went into crisis, China went into crisis, and Japan went into crisis was because of higher rates and a stronger dollar. And part of the reason is as the dollar strengthens, it raises borrowing costs for countries with dollar-denominated debt. There's more dollar-denominated debt outside the United States than inside the United States that is owed by foreigners who don't have dollars than inside the United States. There's $35 trillion that the United States owes. The rest of the world owes a lot more than that in dollars, in a currency that they can't print. And this is what we talked about. This dynamic played out in 2022. The collapse of the British pound, the devaluation of the Japanese yen, debt crisis in emerging markets, Sri Lanka, Pakistan, Egypt. This is a direct result. That was a direct result of U.S. interest rates going higher. So if treasuries stop being bought by foreign central banks, and as a result, the price falls and the yield rises, this is an issue for the entire world. Let me just skip forward a few pages here. So we talk about central bank balance sheets. Again, this is exactly what that chart that's going around this week is all about, and the composition of foreign reserves. Now, we all know that treasuries are not being bought at the same rate as they were, and that gold is replacing them. The problem this has is that they already own a bunch of treasuries. So if the value of US treasuries fall dramatically, then the central banks that still hold them on their balance sheet, which is most of them, their reserves start to fall and they face immediate financial losses, which may force them to tighten monetary policy, sell assets, or even seek emergency support. This is exactly what was happening in 2022. The scale of the losses would be particularly damaging for economies heavily reliant on dollar liquidity, as treasury decline would likely coincide with rising bond yields and a strengthening of the US dollar. So in a full-scale treasury crisis would amplify the effect, which would tighten global credit markets, putting further strain on central banks worldwide. And then we go back to the dominance of US treasuries on central bank balance sheets. Yes, gold is becoming increasingly important and increasingly the most sought after asset. But that doesn't mean that US treasuries are not still a huge asset on their balance sheet. So as those go into trouble and they fall in value, that hurts the foreign central banks. So it doesn't just become an issue for the United States. It very quickly becomes an issue for the whole world. And the other thing is that even though they're not being bought at the same rate that they always have been, and even though as a percent of the overall it's falling and gold is rising, the amount of foreign held US treasuries has never been higher than it is right now. So they are still buying treasuries, just not at the same rate, but the overall outstanding supply is still rising. And then, the last thing I would say is, as gold replaces the US Treasury, the thesis is then that gold becomes the new reserve asset, and you need to have gold to succeed on the global stage. Well, you got to remember, the United States has more gold than anyone. Now, I know some people are going to out there say the U.S., it hasn't been audited in years. Okay. Have the other ones? And you'll say China has a ton of gold, and they've been buying a lot of gold, and they have more than they say they do. Okay. Have you seen their audit? Why do you trust that China has all their gold and even more, but you don't trust the United States? Why do you trust China's numbers, but don't trust the United States numbers? Now, if you want to tell me that you don't trust any government numbers, I'll give you a high five and completely agree with you. But the other thing I would say is, if you think that the United States is accurately reporting all the gold that they have ever picked up in the world, I will argue with you till the sun never comes up again. I think the U.S. has a lot more gold than they say they have. Can I prove it? No, I can't prove it. But for as long as history has existed, countries have gone to war over resources and treasure. And the United States has been at war for 100 years. And if you think that they go into these other countries and come back empty-handed, you're welcome to that belief. So anyway, the point is as gold gets remonetized, or if it becomes more of a global store of value, the United States is not exactly in a bad place on that. Now, some people will say, yeah, but they have the global reserve currency, so on an absolute basis, it will hurt them more. Sure. If this whole system comes down, which is what the whole milkshake is about, that's going to hurt the United States. It absolutely is. But there will be a progression, and the United States is not going to fail first. And in fact, I believe they're going to fail last. And if you want to believe otherwise, that's fine. But if you're going to take on the global hegemon and you're going to storm the castle, at least have a proper idea of how high the walls are and how thick they are. Don't go take them on if you don't fully understand what they're capable of. That's the point of all of this. So it's not that the United States will remain the global hegemon forever. Of course they won't. It's not that the United States dollar will remain the global reserve currency forever. Of course it won't. That's what this entire thesis is about how that process of them losing it. But that doesn't mean they're going to lose it tomorrow. And it doesn't mean that just because gold is going up, that the United States automatically loses. So when you see these charts going around, it's not that they're not important. They're very important. But don't just take the minute everybody says something about this means that the United States is done for and China's going to win for whatever new theory they came up with of why that will be the case. Actually stop and think about it. Think about it on a relative basis. What does the United States have? What do the other countries have? What problems do the United States have? What problems do the rest of the world have? What assets do the United States has? What assets do the rest of the world have? When you start analyzing each company equally, rather than just focusing on the sins of the United States, you start to realize that in a relative game, it's not quite as cut and clear as many like to make it out to be. Okay, that's it for this week. Hope you guys have a great weekend. I know what else. Hold on. One thing. I didn't want you to think that I'd forgotten about this. Hold on. You guys know I have been calling for a correction in the markets, and so far it has not happened. But hold on. Where is this at? For the first time in a long time, equities didn't go up for the week. They actually kind of, the Dow actually went up just slightly. The S&P was down a little bit. The NASDAQ was down a little bit. The semiconductors were down or kind of flat. But the point is that, we're getting very close to where I'm either going to have to raise my hand and say, I just got it wrong. As of right now, I'm wrong. We have not had the correction. I thought we'd have it by the end of the quarter. There's a couple days left. Maybe we'll trade off here over the next couple of days. But I still think it's possible because, everything is just so stretched. But I didn't want you to think I was overlooking this. So far, the market has remained incredibly strong. We've got the government potentially shutting down on Tuesday. That could cause some issues. If the government shuts down, then we won't have non-farm payroll release. We may not have the CPI release. So you get into all kinds of new issues of if the Fed is data dependent and data is not coming out, is that bullish or bearish? It's hard to say. We've had the U.S. You guys know I live in Puerto Rico. The U.S. military has been building up in Puerto Rico. They've been so far they've been taking out alleged drug boats from Venezuela. Now there's reports that the United States is going to actually go into Venezuela. My guess is that they'll go into other places as well. So there's still a lot of things things are ratcheting up with Russia. So there's a lot of things that can still happen. I think markets are definitely overdue for a correction. So we'll see whether we get it. But so far it hasn't happened. Anyway, we'll be back next week and we'll talk about it more then. All right, guys. Bye.